There is currently $1.7 trillion in outstanding student loan debt in the United States. For ambitious professionals, this acts as a heavy anchor on early career decisions. According to data from the Federal Reserve Bank of Philadelphia, this specific type of liability directly correlates with reduced business formation. Every additional $10,000 in student loan debt reduces an individual's likelihood of starting a business by 7.37%. Personal education debt actively suppresses the creation of new companies, keeping potential founders tied to traditional employment to service their monthly minimums. When an entrepreneur finally secures early business funding, the temptation to immediately wipe out an 8% private student loan is massive. Using capital from an SBA 7A loan to settle personal accounts directly violates the program's strict use of proceeds regulations. Doing so triggers an immediate default and exposes the borrower to federal fraud charges. This diagram illustrates commingling, the illegal act of transferring cash from a registered LLC or corporate checking account straight to a personal loan servicer. Courts view this behavior as treating the business as a mere alter ego. The legal consequence is a process known as piercing the corporate veil. Without that barrier, the strict separation between the legal entity and the individual evaporates. Business creditors can bypass the company entirely and place liens on the founder's personal home or vehicles to satisfy corporate debts. A reckless attempt to erase a student loan creates an environment where a single business lawsuit can liquidate a founder's entire personal net worth. The legal method for shifting this burden requires a strategy called strategic debt migration. It begins with establishing an EIN and building a business credit profile completely detached from the owner's Social Security number. For companies that employ a team, the tax code provides a specific mechanism under Section 127. Employers can establish an educational assistance program, paying $5,250 annually toward an employee's student loans, completely free of federal taxes. The limitation is ownership. As the barrier drops, the 5% rule takes effect. Anyone owning over 5% is legally disqualified from these funds. Section 127 serves as an excellent tool for recruiting and retaining talent, but it leaves the solo founder entirely excluded. Solo entrepreneurs have to use a different mechanism, the S-Corp shareholder loan. The mechanics are simple. The S-Corporation secures a low-interest commercial credit line based on its operational revenue, then draws up a formal contract to lend that cash to the owner. The owner then uses this borrowed capital to zero out their high-interest private student loan. The IRS requires precise documentation to validate this. You must execute a formal promissory note to prove a legitimate debtor-creditor relationship exists. The loan must carry an interest rate equal to or above the IRS applicable federal rate, and the owner must make real, scheduled cash payments back into their own corporate account. By treating your business like an independent bank, you replace a rigid personal burden with a structured corporate obligation, keeping the corporate veil perfectly intact. The financial utility of this migration lies in interest arbitrage. This split-screen comparison breaks down the math. On the personal ledger, carrying a 9% private loan offers minimal tax relief. The IRS caps the student loan interest deduction at $2,500, and that deduction phases out completely once an individual's income reaches $100,000. On the corporate ledger, the interest paid to service a commercial credit line is a standard business expense. It remains fully deductible regardless of how high the company's revenue climbs. Warning tone. This strategy requires strict legal compliance. The shadow market is flooded with predatory debt relief companies, charging 20% APRs for worthless services, frequently triggering enforcement actions from the Federal Trade Commission. The corporate veil serves as a rigid legal boundary. When navigated with exact precision, it functions as an active financial lever to restructure liabilities and unlock the capital required for entrepreneurial growth.